Welcome to the Counting Capital Podcast, presented by Buchanan Street Partners. Join our host, Buchanan Street Chairman Robert Brunswick.
Welcome, I'm Robert Brunswick, Chairman of Buchanan Street Partners, and I'm glad to be with you today for our real estate podcast. It's my great pleasure to have as our resource today my business partner and good friend of 28 years, Tim Ballard, President and CEO of Buchanan Street Partners. Let's get started. Hello, Tim.
How you doing?
Good, man. How long we've been working together?
It's actually, I think, 28 years now.
28 years.
Yeah.
Wow.
I used to have a lot of brown hair before. Now it's all gray.
Well,
see what you've done to me?
It still does you right, and it's a great treat to do this with you. We've come a long way in building our business together. And today's listenership is primarily made up of clients, their families, students, people that want to learn about real estate. So I can think of nobody better than to share with them a little bit about what we're going to talk about today, which is really investing in real estate in a broad sense. So before we dive into some of the technicalities, let's get to know you a little bit.
Sure.
Share a little bit about your background.
So born and raised in Anchorage, Alaska, and went to school back east at the University of Pennsylvania in Wharton, and always had a passion for real estate. So moved to California here now. I guess it's been about 32 years ago. So
Right.
I'm pretty much a California native now.
You certainly are. Yeah, you got out of that cold weather. Now you enjoy the warm weather. So,
Absolutely.
Understandable. So you talked a little bit about the broadly, but specifically with careers. So what was your first job? What was that like? And how did you evolve from there? And how did you get hooked up on an entrepreneurial road that you ultimately pursued?
Well, my mom was an entrepreneur from the beginning. And so I think I got a lot of that from her in terms of her kind of building a business and that kind of being the conversation around the dining table. In terms of real estate, my career in real estate really started when I was in college. I was one of the original home flippers. I bought a home in foreclosure when I think I was a sophomore or junior in college for $10,700. And my summer job was swinging a hammer, and I flipped the house for $85,000. So it was quite a nice introduction to real estate.
Today that profit might pay for 1 year of college.
If you're lucky.
If you're lucky, exactly. So, and then where'd you go from there? I remember Mass Mutual, if I'm not mistaken.
Yeah, so my first job out of college was working in the real estate group of Mass Mutual. Okay. And as part of the kind of thought process is I knew I wanted to be in real estate. Most of my friends were going to Wall Street or management consulting. I interviewed for those jobs, and ultimately the job I took paid me about half of my best job offer. But what I knew at the end of the day was I wanted to be in real estate. I wanted to learn about real estate, and I felt that was the best opportunity for it. What I learned there, I was exposed to a lot of things. So obviously I learned a lot about real estate, a lot about real estate lending. I was in a training program that involved both kind of equity investment in real estate as well as on their lending platform. But what I learned is that in many organizations, you're paid for your tenure versus what you bring to the table. And I always knew I wanted to work hard, I want to continue to learn, and that's ultimately why I left to do something a little bit more entrepreneurial.
And what was that next step?
So next step was a name from the past. It was called Coldwell Banker, which is now CBRE.
Sure.
And so that was my second job out of college, and I worked in their they had various names for it, but ultimately it was their mortgage banking group, which was basically lending on commercial real estate assets.
And then what happened?
Then you stopped by a few times and kept knocking on my door and convinced me to join you at Pacific Union. So that was, I think, 1994, so quite a long time ago now.
And what did that experience provide for you?
Well, that was definitely much more entrepreneurial. I had as a young man at Coldwell Banker, I had a relatively easy job in terms of, hey, you go to real estate owners and would you like to borrow some money cheaply? And they would generally say, yes, I'd like to do that. And at Pacific Union, it was a much more entrepreneurial firm. And, you had some skin in the game, and it was a lot of fun, a lot of learning about different kinds of things outside of, lending. There was much of what we did, as you know, Robert, was worked in the equity part of the capital stack.
Sure.
And that definitely you had to understand the real estate and the operator much better than you did as a lender.
So as we kind of fast forward from Pacific Union, obviously we had a couple of other stops along the way where we sold that business and then worked for a public company and then got left there, and then we started at Buchanan Street now almost 23 years ago. So how would you describe to kind of our audience today Buchanan Street Partners as you see it?
Well, today we're an investment management firm, and so we take care of the assets of high net worth families both on a direct basis as well as through their registered investment advisors. And at the other end of the spectrum, we take care of ultimately, public employees through their retirement plans for, various big public pension plans.
Exactly. And you're investing in what?
We invest in a variety of things. So on the equity side of the equation, we are making investments in multifamily housing, self-storage assets, and office assets, and typically focused today in the medical office and life science areas of office.
Interesting. So you're doing some lending too?
Yes. So we have a debt program where we make bridge loans and construction loans, typically in the $10 to $50 million range, to local entrepreneurs, local developers who are looking to create value in their real estate.
So as an asset class, we know, with what's going on with diversification, alternative investments, why historically has real estate or more recently, garnering such a significant amount of the investable asset class base within alternatives? What is it about real estate that is appealing to that capital flow?
Well, I'd start first with is, if you go back to when we started our careers in real estate, it really wasn't an option of investing with a sophisticated manager. It was very hard to access investments in real estate unless you did it yourself or you invested with, your friend down the street who's at the country club trying to syndicate a deal. Very hard for the high net worth investor to invest, and even the pension funds, because it was a bit of the wild, wild west when we started our careers. Today I think people have recognized the importance of alternative assets and specifically real estates in their portfolio in terms of providing a significant level of diversification to the kind of risk they have in their portfolio. Real estate is a cash generator. Many assets are not. Some types of real estate are very favorable for inflation protection. So there's a variety of reasons today that as you grow a portfolio, it's important to include real estate as one of the assets.
So you talked a little bit about inflation hedge, cash flow, other attributes or benefits to investing in real estate. It's obviously non-correlated to equities and bonds. Anything else that comes to mind?
Well, it's not necessarily completely uncorrelated, but it's less correlated to the public markets. Certainly there are avenues of investing in the public REITs that own real estate, and those are correlated to the public markets. So private real estate is a little bit different than public markets. And then for the high net worth investor or the taxable investor, there's significant tax benefits available to investing in commercial real estate.
So Buchanan Street as a business has evolved from predominantly institutional investors to high net worths, family offices, registered investment advisors. Is that really just a byproduct of those investors now showing up in the marketplace and they're much more active? What has been, or is that a purposeful shift for the company as they've really expanded the platform?
Well, I think it's really both things. Over the last, I'd say, 10 years, it's become, in the industry, alternative assets have become a more important part of the strategy that high net worth investors deploy their capital with. And what you've seen is a number of registered investment advisors have been formed basically coming out of a need. So what investors recognize is maybe they weren't being served well for their goals by the big brokerage houses. And so you've had a lot of these registered investment advisors formed to really address the needs of very wealthy families. And so with that, those families, those investment advisors have been able to, focus on strategies like ours that are, probably a little bit more boutique in nature.
Tim, we should probably cover off, obviously there's a lot of attributes to investing in real estate, but what are the risks? What should people be thinking about as they think about risk?
It depends really on the kind of real estate assets that they're looking to invest in. So, there are risks at one end of the spectrum that are fairly significant. So, if you buy into land or development assets, you may be taking entitlement risk. So in some areas like Texas, that's fairly limited. In places like California, entitlement risk is a massive risk that's very unpredictable in terms of the timing and what the result might actually be. As we've seen during the pandemic, we've had a lot of inflation, and that's been due to both commodities price inflation as well as supply chain issues. And so with that, construction costs on some types of assets have gone up 50% or more. We've also seen the challenges with labor. So you might have expected that you would develop an industrial property in 9 months from the start of construction. Sometimes those are taking 12 to 18 months today just because of the lack of labor and your inability to get certain, commodity products like steel products. And that's really challenged people's, underwriting as it relates to, interest carry and the development costs. So there's a variety of different kinds of risks that you have in real estate. At the other end of the spectrum, if you buy a, brand new Class A apartment complex in an urban location, you're not going to have those same kind of entitlement challenges, construction cost challenges, leasing challenges. In those situations, you're going to have different kinds of risks, which will be market risks, what's going on in the overall general economy, what's going on in the local economy, things like that.
So as you're talking about risk, do you really view liquidity, access to liquidity as a risk or just kind of a reality of private investing?
Well, it depends on the investor. So, if you're a large pension plan or you're a very wealthy family, you're not seeking to make investments in private investments to use as a liquidity tool. So I don't view the risk of liquidity for that investor to be a significant risk for them. But having said that, there's a big range of liquidity opportunities and challenges in that, you can own, you own an apartment complex here in, coastal California, you want to sell that thing, you're going to very predictably sell that with a long list of buyers because the market is so deep for that kind of asset. Having said that, you own a piece of land in some tertiary market, it might take you 2 years to sell. It might take you 5 years. You just don't know. And so it's certainly something that you should address and make sure that it is consistent with the liquidity you might need in that investment vehicle for your investors.
Tim, our business has evolved tremendously. If you think about back to when you started to today, and reflecting on that, what's most different today than when you originally got into the business?
Well, the business was really the wild, wild west. There was very little transparency of information. There was no predictable good flows of data. I remember in starting my first job, if you wanted to figure out what rents were or vacancies, you'd get on the phone and call people. You call an owner, you call a leasing broker. What do you think rents are? And so you might end up with 10 data points. Well, today, it's just night and day in terms of your access to information about markets, about new supply, about rents, about the economy. And so what it's really done is made real estate a much safer asset class to invest in because you just have a lot more knowledge about, whatever you're about to do.
So tell everybody about what is your job? What's your day-to-day job? What do you do?
Well, you got to do all sorts of different things. So, as an entrepreneur, and the kind of business we have, I get to, look at investments. I got to look at design. We look at construction. We look at, how we mitigate risk. We look at how do we build culture in our company. There's a lot of things that you get to do in a small company that you might not necessarily get to do in a larger organization. So that's something that really feeds me. I like having a different day every day.
So you prompted me to my kind of next ask, which I know you well enough, but I think it would be fun for everybody to hear. What do you like most about your job? If there's something you could do more of, what are you passionate about?
Well, I'm passionate about learning, so I like to figure things out, and so the real estate industry gives me an opportunity to learn something new every day, and that's one of the things I try to tell our young people is as you grow older, what you learn is how little you really know. And if you approach it from that standpoint, I think you're much less likely to make a mistake, and your investment decisions can be better founded in what is the truth at the end of the day, because you've really learned what are the nuts and bolts of how you do this versus it being just data on an Excel spreadsheet. Well, really, how do you build this? How long does it take? What's it cost? Who are the people that need to be involved? What's the best way of doing it? How do you, bring a product to market that's interesting to, the tenants in that market? How does that office space result in a company being able to attract and retain employees? So there's a lot of things that you need to learn about to be any good at this job.
So with that knowledge and experience, you obviously have an investment philosophy at Buchanan Street. We have an investment philosophy. What is Buchanan doing today? Can you give kind of color an example of some types of things that they invest in and maybe why?
Sure. Yeah. As we were talking about a little earlier, we make apartment investments, self-storage investments. We make loans. We make kind of niche investments in the office space. One of the things that we've been doing here very successfully over the last couple of years is making apartment investments where we've been buying them just coming out of the pandemic as they were just finishing lease up. And so these are Class A apartment assets in high growth markets that what we were able to see is a confluence of a couple of factors, is replacement costs going up dramatically. And so the prices that we're able to buy these assets are less than they cost to replace them. So that's a thing that's a kind of a bedrock of our investment philosophy, is try to buy things right and for less than it costs to reproduce them. That's really a hedge against future development in terms of if you or to build more supply, that basically means you need to have higher rents. So we like higher rents in what we do. The other thing that we saw in the pandemic is, there was a bit of softening in different kinds of assets. There was, a lot of people, younger people maybe moved home with their parents, maybe they moved out of the urban locations. And so some of the leasing of these apartments was, I wouldn't say challenging, but was not robust. And so we were able to underwrite, rents based on what had been going on over the past 12 months versus what really transpired over the months thereafter. And so, post-pandemic or toward the end of that pandemic, people started, realizing this wasn't the end of the world, and moved back to these apartments. And we've had tremendous rent growth in our assets, and there continues to be fairly rapid rises in construction costs. So we feel that we have very defensive positions that have been able to take advantage of this kind of growth in rents.
So we've been in the storage business, you and I, for a long time, really as a lender, as an intermediary. So more recently, we've gotten into the self-storage ownership business. So maybe you can share with folks what really prompted that, and where do you see an opportunity? Because what you hear is lots of money coming to storage, and maybe it's an overbid or oversought after asset class. So share a little bit about what prompted that start to that business line.
Yeah, well, so a thing that we realized along the way in kind of building our business is that the most important resource that we have as a business is our people. And so I had spent a couple of years with a young man who was in the self-storage business, working for one of the larger operators here on the West Coast. And just over time, as I got to know him and mentor him, I just figured he'd be a great fit for our business. I liked what he was doing, and it really gave us the opportunity to support a rising superstar in the business. And so, what we've seen so far out of that is, one of the things that we try to deploy at Buchanan that helps us generate returns is find things on an off-market basis. And so actually every self-storage asset we've bought so far have been on an off-market basis. And given the very kind of fragmented nature of that business, we think we've been able to make some very good buys without the marketing process.
And the strategy has been more to buy brand new, kind of not yet completely leased or leased at all investments. And do you view that as an undue risk, or tell me how you see that as you kind of look at the investment opportunity?
Well, the reason we identified kind of these pre-stabilized assets is we thought there would be a nice kind of arbitrage between the ultimate value when they're released and the value that we could buy them from. Because basically we're buying these from merchant builders whose plan is to sell the asset as soon as they can to generate the highest IRR. And so the builder has taken out much of the risk by developing the asset, getting it completed, and then starting to lease it, and you can then see what the rates are for that particular asset. And so what we are basically bridging is the difference in between the opportunistic returns of doing a development transaction and the returns of a more stabilized asset. So we believe we're getting paid very handsomely for the risks we're taking. We think the lease-up velocity, the levels of rents are very predictable in the locations that we're in, because these are urban locations with lots of other assets within 2 to 5 miles that you can look to understand what people are willing to pay and the demand demand for the space.
So despite its vacancy risk going in, it's got great predictability to its ultimate lease up and stabilization.
So, whether it's 12 months or 24 months, that's not going to make a material difference in terms of, the ultimate results if we're buying assets that we're hoping to hold for 10 plus years.
Tim, you started in the lending business. You and I have been involved in lending in different ways. So I understand Buchanan's platform of equity and direct ownership, which was kind of an evolution for the entrepreneur away from being an asset allocator with other operating partners. But it looks like you're quite active in the lending business today. We are, I should say. So tell me a little bit about why lending today and what's that a proxy to, and why do you like having that business line as part and parcel of your real estate ownership?
Part of the reason we really like lending is much of the lending universe is capitalized by highly regulated institutions, i.e. banks. And so if you're a bank, it takes a long time to get a loan done. You have a fairly bureaucratic process generally for making those loans. And so a borrower may have an expectation of applying for a loan, after they went to the market and tried to figure out who they want to borrow from. That might take them 2 or 3 months to get that loan. And they're not really sure if they're going to get the loan as they applied for it at the end of the day, because they don't know the people that are the decision makers. And so, as you know, in the lending space, we've really found a niche where we can do things where speed of execution is very important. It's very important in terms of the types of loans we make. We make construction loans and bridge loans. So there's some reasonable level of execution risk in the type of loans that we make. And if you're a highly regulated lender, it's much more difficult for those types of organizations to figure out what that risk is. Mm-hmm. So the way they do that is they lend a lot less, don't lend at all, do it through recourse. And given that we're an operator of real estate, we know how to build much of this stuff, we know how to lease this stuff, we know how to execute on it. We're very able to understand that risk and find the right situations where we can make those loans. And when we do, we get paid fairly well for doing so.
It sounds like your investors have enjoyed the evolution with that leg of your investment platform, because it kind of gives them almost a proxy to a fixed income like investment return.
Sure.
Which is diversified away from their equity risk.
Yeah. And it has a lot less volatility. In a equity investment, you're if the market rents go up or down, that's going to significantly impact your returns. If cap rates go up or down due to capital flows, that'll significantly impact positively or negatively your returns. And when we make a loan, we're going to have 25 to 35% equity subordination from our borrower, and so it is a much more predictable outcome in terms of the yields that we earn on those loans than you would in an equity investment.
You and I have been doing this a long time. We've been recruiting young people, training them, mentoring them. We enjoy that. I enjoyed my time teaching at UCI. So as you think about our viewership today, I think it would be fun to hear if you were to message to young people that are thinking about real estate as a career. What might you tell them about this as an opportunity?
I think it's a fabulous opportunity. But it's for the right people, in terms of what we do. Real estate is a very broad industry. So, there's a home for almost everyone, whether you're the analyst, whether you're the marketing person, whether you're the entrepreneur. And so it's become a very, very big industry. I was talking about this a little bit earlier, which is when I started my career, the entirety of the REIT industry was $600 million. Today, the entirety of the REIT industry is over $1 trillion. And there are REITs that are almost 100 billion in size alone.
Sure.
And so it's become a very different industry, but I think there's a lot of opportunity yet still in it. In real estate, on the investment side, the development side, there's the ability to shape communities. There's the ability to shape how people work. There's a lot of things that you can do to influence, your community, and it's very important. It's certainly it's a big user of energy, and there's ways of thinking about how to bring efficiency and making our world a better place. So there's just lots of things. So there are many things that depending on how you're built, how you're wired, that it's a great opportunity.
Well, thank you for the time today. I know everybody's enjoyed it. I have. It's fun. As much as our offices are next door to one another, we talk all the time. It was fun to do this podcast together. I hope everybody has enjoyed the podcast today. It's a treat for me to have Tim as part of our resource group, and we'll look forward to seeing you next month with our next guest. Thank you very much.
Thank you for joining us on this episode of the Counting Capital Podcast. To learn more about Buchanan Street Partners, please visit our website at buchananstreet.com. Buchanan Street Partners. Capital you can count on.